Hey, everybody, September 10th, the market update desk with Scott Riley, NMLS 157152. Wanted to go over some of the information from yesterday on the QCEW and today's wholesale inflation report. Yesterday, we had an analyst convention up at Arcadia Bluffs and had a great time up there with a couple good friends. So, wanted to go into a little bit more information on that QCEW. It's actually quite staggering. Now, we've been hearing from Fed Chair Powell and others that they weren't concerned about the labor market. They considered it strong. Um, Quite shocking based on the numbers that we've been getting and especially the revisions. Now, this report yesterday puts even more emphasis on the fact that they got it wrong. Now, the QCEW is showing that payroll growth in the 12 months from March preceding March 25th was revised by 911,000 to the downside. What that means on average, each month over month time period was overstated by a shocking 76,000. And 52% of the jobs that were created were thin air. They were never there. They were bogus. The largest revision, in fact, it's the largest revision on record and shows that the labor market has been much weaker than previously thought. In fact, the largest downgrade was in leisure and hospitality. They lost, they subtracted 176,000 jobs from what was reported. It's not surprising because the BLS didn't match up really with ADP in there and the JOLTS report for that specific sector. So now that we see this revision, it shows that those were more correct than the BLS. Now, remember, it's very important that rates had moved lower in advance of the September 18th rate cut last year by about 5/8% and were stable for a few weeks. But then, boom, started to increase significantly after the blockbuster September jobs last year report that we got on October 4th. And that was followed up by what appeared on its face as a strong November and December report. And that also was causing rates to rise. Yesterday's QCEW report is just another reason why the Fed needs to start cutting rates now. And in fact, there's a lot more whispers today that they could need to be looking at a half a point rate cut next week versus excuse me there versus just a quarter point. So it's going to be a lot to see. The New York Fed's Consumer Expectations Survey for August showed that the mean perceived probability of finding a job if one's job was cut fell by almost 6% to 45%. So, one of the things I just want to emphasize is last year we were talking to people, prepping people about refinancing, and some of my customers were ready to save $450 a month, getting into the low fives from where they were at. Many of them held off thinking that rates would get to 5%. They did not, and that 5/8 to 3/4% jump that we had right after the Fed cut last year 50 basis points put them out of reach for what they could have saved. Now we're starting to come up on that again, and I'm stressing don't wait for what you think rates will be at. Look at the savings you can have and take advantage of it. Now, today we did get the PPI or wholesale inflation report for last month. Quite shocking, actually, to the good. Wholesale inflation, it showed on the headline, fell negative 0.1%. In fact, the forecast was to be a plus 0.3%. Additionally, on top of that, two previous very hot readings of 0.9 were reversed downward to 0.7. Year over year, headline wholesale inflation fell downwardly, revised from 3.1 to 2.6%, much lower than the street was expecting at 3.3%. And in fact, core PPI, which strips out food and energy prices, also fell 0.1%. Previous reading also revised downward from 0.9 to 0.7%. In fact, year over year, core PPI fell from the revised 3.4% all the way down to 2.8%, much lower than the 3.5% we were expecting. Now, this shows potentially that there is more margin compression and less impact from tariffs than many thought. Now, we do have a lot to see about that, but watching CNBC this morning, it could be that more production is being done by the same amount of people. So efficiency is increasing, and also maybe AI usage, which is helping absorb that impact of those tariffs. The big component adding to inflation is still portfolio management, which kind of sucks. And I don't think it should be included in this report because the management fee as a percent hasn't changed, but the dollar amount has changed dramatically because we're seeing all-time highs in stocks. So that dollar amount is actually increasing. So the PPI or wholesale report has a 12% influence on the PCE report that will come out later this month. So maybe not as impactful, but it's still to the positive. One of the other things I was watching this morning was the supercore, which is subtracting out food, energy, and one other aspect was actually up 3.3%. So it kind of went in opposite of what the headline and core was doing. So that is something that we're paying attention to. Mortgage applications last week, not surprisingly, purchases popped 7%, refinances 12%. You can see activity coming back in the market. If you wait, you could end up paying more for a house because more competition. If you wait to refinance, we just don't know how long rates stay. Sometimes there's very brief opportunities to save this money. So grab the money while you can. 10-year Treasuries acting very good today. Came back from yesterday's slight tick up. We're at 4.05%. Mortgage-backed securities up 13 basis points. Now, this next line of resistance for the 10-year Treasury is sitting at 4.01%. Now, we get CPI later this week. We got a chance to go below that 4% marker. In fact, I was looking at some of my reports for this day last year. The 10-year Treasury got down to 3.7%. Man, if we could get close to that again, we might be sitting in the 5%. Give us a call. We're on top of everything. We can help explain the market, help you make great decisions for your family's financial future. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan, 616-293-2189.